Joining us now, Melius Research's head of energy and power research, James West. James, a lot to talk about. The battery stocks have been red hot. Do you still like any of them, or have they run too far, too fast?
No, Brian. I think thanks for having me on. I think the battery stocks still have more room to go. Batteries, in general, are the fastest growing subset of energy and energy storage out there. And with EOS announcing a new product recently, with long duration storage being necessary for grid reliability, we're only getting started with batteries in the United States.
Okay, only getting started. I mean, 500% run for Bloom Energy. I know these are not all the same companies. Some are more batteries,
Sure.
Some are more are traditional storage. I am sort of unfairly lumping them together, James. Any part of that group that you like more than the others?
So certainly Bloom has an interesting product portfolio, and because they have a solution for AI data centers in highly populated areas because they're quieter than turbines and they consume natural gas, they've obviously seen a big run, but I think that run will probably continue. I think with the other ones, Fluence as a packager of batteries and EOS as a developer of batteries are still in the early stages of what is going to be this build out of battery infrastructure to support the grid. So, they're different businesses. You're right; they're a little bit unfairly lumped, but both, I think, in terms of a business standpoint, have more room to go. But also, I think from an equity standpoint, we're early days in this whole grid infrastructure, AI data center build out in the United States. I mean, I'm not even sure we're first inning. We're at batting practice.
Yeah, and I think that, James, natural gas traders and investors are still, they look at today's pop, which is historic, don't get me wrong, but
Sure.
We were at $5 like a month ago, and now we're at $4. And this is with this crazy cold coming, like historic cold. So once again, it's proving to be the widowmaker trade. Where do you think it settles from here? I mean, even with all of the demand, it's remarkable that this commodity is not really budging in price.
Yeah, that's right, Kelly. I think that we're going to see just massive volatility over the next several years as we sort out the natural gas markets in the U.S. We need to build pipeline infrastructure. We need to get the pipelines into the data center areas, whether that's PJM, whether that's ERCOT. It doesn't really matter. But right now, we're in a little bit of distorted pipeline infrastructure situation, if you will, Kelly. So I think that volatility is going to be there. We always have volatility in winter. It's cold in the Northeast, as you and I both well know right now. It's going to be very, very cold for the next week or so. And so I think that we've got a run that could take us back up well over $4 here for natural gas. But springtime does come, in the next few months. So we will go back down. I think you need $4 roughly to incentivize most natural gas drilling activity in the United States.
Yeah, I mean, some of these, I know it's short term, James, negative 25 in Chicago, a foot of snow in Nashville. We know how well they do with ice and snow down south. They're going to be out of work for like 6 weeks. I'm kidding, sort of. What is on your research list, coverage list? What is the one or two best energy plays right now for anything?
Well, EQT, by far, the biggest natural gas producer in the United States. They have a vertically integrated strategy, so they have the infrastructure, they have the drilling capabilities, they have the certainly the production capabilities. And so with this PJM, quite frankly, this emergency auction that's coming up, that's going to just add more to the upstream part of their business, more gas to sell into that market. And so by far, EQT is the best positioned natural gas play right now. On top of that, I would argue that some of the infrastructure equipment manufacturers like Baker Hughes, who sells a lot of equipment into natural gas, also into LNG, which is part of the natural gas story, very well positioned too.
If I may pivot, I mean, I was really struck by what Harold Hamm said about how, what was it exactly, Brian? He said we're no longer drilling in the Permian or something to that effect. So, James, is that the case? And the government itself seems to be trying to make this case that, no, there's more resources in the Permian and we're going to be fine and there's a lot more to tap. But what does it mean for the producers and for the oil price?
Well, I think right now what Harold Hamm is saying is in the Bakken, which is basically his home area. Harold is telling us, Kelly, that we're not profitable at these levels. And so this, drill baby drill mantra that the Trump administration has been pushing has pushed oil prices down too low. And we've actually incentivized drilling in the Middle East. We're incentivizing drilling in deep water Those areas, we don't have issues with inventories of wells to drill. We don't have issues with rising costs. They're actually competitive, very competitive versus U.S. shale. And so we're kind of in the early stages of the twilight of U.S. shale here. It'll be a long goodbye, but Harold's being pragmatic. He doesn't have shareholders. He is the only shareholder. So he's not talking to the market overall. He's doing what a businessman would do that controls the entire company.